All right, good afternoon, everybody, and welcome to our new research offering. It's called 3 and 3, where our goal is to show you three important things we're watching in 3 minutes. So let's see if we can get it done. Here we go. So the first thing we're looking at is the premium of U.S. hot rolled coil steel prices versus those in China. And what I'd like to highlight, you can see I'm moving the marker here. This typically peaked before at about 300. It troughed about minus 200. And what this is the arbitrage in terms of when it's a high price, steel is flowing into the US and the economy is kind of fine. What I'd like to highlight for you is that we had, this was the COVID crash. The world kind of ended for a bit. And then we had this huge spike, which was an incredible front loading and inventory hoarding. This peaked out about November. Been softening since. You can see there was this big price spike right here. That was Mr. Putin's invasion of Ukraine. So what I'd like to demonstrate, the number one takeaway here, is that we're coming off of an extended super high level of the US premium in steel prices to the rest of the world. So to me, this means the economy is decelerating. Number one, from a very high level. And number two, I'm going to show you how, when this exactly took place. It was basically April 14th, which is the second chart I wanted to show you. So here what we're looking at is the price of scrap steel in Turkey. And what I'd like to highlight is that it was at a high level back here. This is before Mr. Putin rolled into Ukraine. You can see a huge price spike. This is because Russia and Ukraine are a huge source of steel exports in the world. So this was essentially rapid. We were already, remember, at very high levels. And then there was a crazy squeeze on top of what had already been a crazy squeeze. So inventories, there was a tremendous demand for inventories. There was a tremendous amount of pre-buying. That essentially broke right about there, which is in the third week of April. And things have been decelerating since then. The reason I'm highlighting this is that the steel market is more than $1 trillion market. It's one of the biggest industrial markets in the world. And as it goes up and down, in terms of the moves in that cycle, it tends to be illustrative of what's going on in the industrial economy, which frankly is a wonderful leading indicator for what's going on kind of in markets and in the world. So number two takeaway from our chart here, rapid deceleration this is an inventory destocking cycle from a very high level. And frankly, we're plunging to new lows yet again today. This is another evidence sign for me that things are decelerating. Now, the final thing I wanted to show you, the third thing for our 3 and 3, is what this means about our asset allocation, why we're set up defensively, okay? So in blue here, we show this is that scrap steel price we were looking at. What I wanted to demonstrate is in yellow, this is the inflation expectation that is priced into the US government 30-year bond. And lo and behold, you can see it's pretty tight correlation. It's been very tight for a long time, and this makes sense to me. So the third and final takeaway here is that many things we're watching show a deceleration of the industrial economy. What we think this is going to do is that inflation expectations have peaked. We think there'll be weakness kind of in the back half of the year. We're set up defensively to profit from this, in our opinion. And this is, I think, a strong argument for high quality US long-dated bonds, which are a much hated investment. So this is one way to think about the three things we're watching in the market, why we're set up the way we are. So that's the first edition of our 3 and 3. Peace out.